Indian IT services companies again have been a story of global digitalization, in the sense that businesses worldwide, consumers worldwide, adopting digital technology to basically pursue their interests and grow their businesses. And clearly, Indian IT services companies have been partners in a way achieving that goal, or achieving that, in a way, if I may use the word, mission. In the process, of course, some of these companies have done remarkably well. The sector as a whole has done remarkably well, partly aided or significantly aided by basically margins, because they've not had to spend on marketing and travel and all of that. Two is basically a strong dollar has given them the extra cushion in terms of margin. So both these factors have been drivers of the margins. Going forward, the way I look at it, Neeraj, is that clearly valuations now are stretched, especially among the tier 2 names. When I see companies trading at 40, 50, 60, 70p multiples to trailing earnings, these are high, not just by historical standards, but they're high just in absolute terms. And, currently, while the growth outlook is very, very strong, but maybe there will come a point of time, a year, 2 years, 3 years later, when the growth outlook may not look as resilient and robust as it is now. I mean, we have to keep in mind that today, of course, there is adoption of technology, which is driving, business and driving revenues. But at some point of time, the technology adoption will become more ubiquitous, more universal, more widespread, and therefore it would become a highly penetrated kind of, in a way, opportunity, and we'd have to wait for that next big leg of technology, which could again be many years down the line. But there will come a period, a hiatus in between, where these businesses may not be able to sustain a double-digit growth rate, and the markets will, in a way, move ahead and price that accordingly. So my view is that currently I would probably be more neutral on it, in the sense that, in a way, positive on business outlook, but a bit cautious in terms of the valuation. So on the whole, I would probably just be neutral. If at all there would be further appreciation in stock prices, maybe it's an opportunity to start trimming, start exiting. And if, of course, there were to be a correction in their stock prices, a meaningful correction, maybe then that's again an opportunity to basically load up and buy into these things.
Okay, so suffice to say that you actually essentially playing the valuation game right now out here. Maybe you have companies which are not exorbitantly priced or egregiously priced. And if they were to move to that band, then you might be happy selling them off as well.
Yes. Just one caveat here, Neeraj, that what I've seen is that there are still some of these mid-cap or tier 2 companies which still are, in a way, bordering around margins of 13 to 14%. Now, if some of these companies can do a bit of inorganic acquisitions and, in a way, create some additional skill sets or get some additional customers or gain some domain knowledge, number one, and can move up their margins from 13, 14% to maybe say 17, 18% over the next 2-3 years because of a bit of, added offerings that they are having, a bit of scale, and all of those benefits coming, then maybe those would be exceptions to this outlook. So I clearly believe that watch out for companies where margins are still maybe, sub 15%, but have the ability to, in a way, trend up more towards the 18% kind of margin range. If that were to be the case, maybe they still remain buys.